So anyway, just a little bit of a continuation of what I was discussing yesterday. We got the non-farm payroll numbers that came out today, right? The jobs numbers, and everybody is really excited about these job numbers when they come out. And I forget, when the jobs numbers became the most important, because I remember when I first started out in my investment career, nobody really cared about the jobs numbers. Everybody just cared about the money supply. Actually, no. When I started, we cared about the trade deficit. It was before I started they cared about the money supply, because I was in the industry in the 1970s. But back then, everybody just waited till Thursday afternoon to get the money supply numbers. That was the big number. That's because people were worried about inflation in the 1970s, and they understood that inflation was about money creation. But after that, throughout all of the 1980s, the big number was the trade deficit. No one cares about the trade deficit anymore. Now it's just the jobs numbers. But a lot of these numbers are quite meaningless. But we got the jobs numbers today. And there were 225,000 jobs created, which was more than about 160,000, 170,000, which had been the forecast. So everybody's excited. I'm sure Trump has tweeted about it. I haven't checked Twitter yet. But he must have done something about this jobs number. But of course, 12,000 manufacturing jobs were lost during the month of January. That's 3 out of the last 4 months we've lost manufacturing jobs, lost them. But what they also released in the same report was they went back to 2018 and revised down the estimates for the number of jobs that were created that year by 370,000 jobs. So that means that the monthly numbers that we got in January, on average, were almost 31,000 fewer than what was told. So if they told us it was 200,000, the real number was 169,000. That's a pretty big number to be off by. Who knows how much 2019 is off by? We haven't gotten those revisions yet. But if you actually look at it now, you have Trump's been in office for 3 years. And according to Donald Trump's State of the Union address, the economy is booming, right? The likes of which the world has never seen. He inherited this dismal economy with no job creation. And now it's a booming economy because of all the jobs that are being created now that he's completely transformed the country. Well, over the last 3 years, 2.1 million jobs. That's how many has been created on average per year for 3 years. Well, how many jobs were created just in the final year of Obama when the economy was an economic wasteland? Oh, we created 2.35 million jobs that year. So we are creating fewer jobs now under President Trump than we were creating under President Obama. And it's not because I'm talking about what a great job Obama did. Obama did a lousy job. But Trump's doing a lousy job too. He has simply inherited the Obama economy, and it's proceeding on the exact same trajectory. Unemployment was falling the entire time Obama was president, just like it's falling now. Donald Trump as a candidate said, yeah, but that's BS. Who cares about these government statistics? They're not telling the truth, and Trump was right. They didn't tell the truth then, and they're not telling the truth now. What we actually have is a bubble. That is the problem. And the credit or the blame actually falls not on Trump, but on the Federal Reserve. It's the same failed policies that we've been pursuing since Alan Greenspan. That's what's perpetuating this bubble. Now, Powell tried to normalize interest rates when he first got the job, right? Something Janet Yellen never attempted to do. Neither did Ben Bernanke, right? The Fed raised interest rates one time before Obama was elected president. That's it. One rate hike. And the market started to fall apart when the Fed hiked rates in December of 2015. That's why they didn't do it again until Trump had been elected president. The second rate hike happened in December 2016, a couple of months after Trump was elected. I think that had Trump lost that election, had Hillary won, we never would have had the second rate hike. We would have been back at zero much sooner, because the only thing that postponed this next recession, which is coming and which will be far worse than what we experienced in 2008, the reason that the recession didn't happen is because Trump surprised everybody by winning. Now, it didn't surprise me. I was one of the few people that said that I thought he could win. But most people thought he couldn't win, that Hillary couldn't lose. And at the same time, people were saying, oh, it would be such a disaster if Trump were to become president. Oh, the market's going to crash if Trump becomes president. What was I saying back then? I said, wait a minute. Why is Trump bad for the stock market? What is he promising to do? Cut taxes? Reduce regulation? How is that bad for the stock market? Nothing that Trump was promising was bad for the stock market. No, the stock market was overvalued when Trump was elected. So the stock market should have gone down just based on the fact that it was a bubble then. Trump was right about that. But there was nothing specific to Trump that was more negative for the market than Hillary. Right? So the market, and then when Trump won, the market rallied. And optimism. People became more optimistic, especially small business people became more optimistic. Most of them are Republican. After 8 years of Obama, they said, okay, finally, we're going to get some relief. We're going to get some tax cuts. Right? People got excited about the economy. And we did get some tax cuts. At least most people did. Some people, depending on where you live, if you live in California, you live in New York, some states, your taxes went up. But most people got a tax cut. Corporations got pretty big tax cuts. And so that initially provided an artificial boost to the economy. The reason it's an artificial boost and not a real boost is because they weren't real tax cuts. Because a real tax cut is when government reduces spending. And then when government reduces spending, you don't need the tax revenue to pay for it anymore. The type of fake tax cuts that Donald Trump gave us is when you increase government spending while you're cutting taxes. Because there's no such thing as a free lunch, right? The Democrats can't give you a free lunch when it comes to welfare spending, and the Republicans can't give you a free lunch when it comes to tax cuts. We have to pay for government one way or another. And if we're going to reduce the revenue that's coming to the government through taxes, yet the government is still spending, where is the government getting that money? There's only one source, and that's the taxpayer. The taxpayer can either pay directly by paying taxes or indirectly through inflation, right? Either the government takes your purchasing power away from you, or they take the purchasing power away from your money. And that's what Donald Trump chose to do. Instead of taxing you with income taxes, he's taxing you with the inflation tax. Right? The Fed is printing a lot more money now than it was in the past. In fact, if you look at the Fed's balance sheet, it is growing faster than ever. In fact, the non-QE involves more debt monetization than the actual QE. But because we got that stimulus, that Keynesian fiscal stimulus, that provided a boost to GDP. And that also provided some cover for the Fed, right? It created a false sense of confidence for Powell that he could keep raising rates. Right? That something that Bernanke never did, something that Yellen never did, but he comes in, he thinks, oh, I'm going to raise rates. And so the Fed kept raising rates, quarter point. And the market kind of ignored this up until the fourth quarter of 2018, when it all hit the fan. And I remember the rate hike in September, when the Fed did that hike, got up to like 2.25. I said, that's it. I said, that's the hike that broke the camel's back, and we're going down. The market's going to go down. The Fed hiked too many times, and they pricked the bubble. And then we ended up having the worst December in the stock market going back to the 1930s. It was the market imploded in the fourth quarter of 2018. And it wasn't just the market was going down. The housing numbers were terrible. The auto numbers were terrible. Everything that was interest rate sensitive was imploding in the fourth quarter of 2018. And then what did the Fed do? The Fed panicked, and the Fed did exactly what I said they were going to do. In fact, I was on Fox Business 2 days before the December rate hike, and I said that the Fed was going to hike, but that would be the last hike, and that the very next move that the Fed would make would be to cut rates. Nobody believed that forecast. Goldman Sachs still thought the Fed was going to hike rates by 4 times in 2019. I said they were going to cut rates. And in fact, not only did I say they were going to cut rates, but I said after they cut rates, they were going to go back to QE. And even though they haven't admitted it, that's exactly what they've done. And in fact, even most of the conventional Wall Street firms have called out the Fed and says they're doing QE4. So they're doing it. And they're doing it because they had no choice. Although they had a choice, but doing the right thing would have meant a massive implosion in the economy, a worse financial crisis than the one that we had in 2008. So because they didn't want to do the right thing, because they don't have the guts to do that, they went back to the same policies that inflated the bubble. So they slashed interest rates 3 times. We're back down to 1.5%. We're on our way to 0. And we may even go negative. Who knows? They're talking about the possibility of negative rates. Now, they're already negative in a real sense, in that the interest rates are lower than the inflation rate. So that's negative real rates. But they're still nominally positive. And quantitative easing is going to continue. They don't have to go back to it because we're already doing it. They may just eventually admit it. In fact, the distinction without a difference that the Fed is making now to try to rationalize why what they're doing now is not quantitative easing is that when they were officially doing quantitative easing, the Fed was monetizing longer-term government debt. And now they're monetizing shorter-term government debt. So supposedly, that's the difference. But it doesn't matter about the maturity. What matters is that they're monetizing government debt. And the fact that they're monetizing shorter-term bonds simply means they have to keep monetizing them over and over again every time those bonds mature. Who's taking pictures of me? Oh, okay. No, but anyway, where was I? So the underlying problem is we have a debt bubble, right? By keeping interest rates artificially low, the Federal Reserve is perpetuating a bubble economy. What the economy really needs are higher interest rates. Higher interest rates would discourage the type of consumption-related borrowing that is going on. We would have real savings. We'd have real investment in plant and equipment, and we'd be able to grow an economy instead of inflating a bubble. But because of what the Fed is doing, everybody is borrowing too much money. Consumers are loaded up with debt. They're borrowing to buy overpriced college degrees. They're borrowing to buy cars that they can't afford. They're borrowing to finance, consumer goods that they're buying on credit cards. We have record levels of debt, credit card, auto, student loan. Same time, they're telling us that we have a booming economy. If we had a booming economy, consumers would be getting out of debt. Consumers would be paying down their debt. See, in a booming economy, you have more savings. You're earning more money. Debt goes down. It's in a bubble economy where debt goes up. The same thing with the federal government, right? Donald Trump claims the economy is booming. Well, then why are the deficits going up? If the economy was booming, the government should be collecting all this tax revenue from a booming economy. If the economy was booming, the government should be spending less money on social programs. So the deficit should be coming down if the economy was booming. It's when the economy is not booming, when it's contracting. That's when you have an increase in government debt. And the interesting thing is, if the debt is rising to this degree now, when we're not even officially in a recession, imagine how much larger these deficits are going to be when we are in a recession. Now, corporations, too, they're borrowing money, but they're not borrowing money to invest in plant and equipment. They're simply borrowing money to buy back their own overpriced stock. None of this is helping to grow the economy. It is helping to push up the stock market, and Donald Trump claims credit. He says, look, the stock market is booming. That's proof that I'm a good president. Well, the stock market went up when Obama was president, too. Does that prove that Obama was a good president because we had a booming stock market when he was president? No. Stock market's got nothing to do with the economy. In fact, it's because the economy is so bad. That's why the stock market is going up. The stock market is going up because the Fed is cutting rates, because the Fed is doing quantitative easing. That's what's pushing up the stock market. If the economy wasn't this lousy, the Fed wouldn't have to do that. In fact, at the same time Trump is claiming we have the greatest economy ever, he's complaining that interest rates are too high, that the Fed isn't printing enough money. Those are the very measures that the Fed used because the economy was weak. Right? Now, of course, the economy was weak for a reason. The recession is actually the healthy part of the business cycle. The problem is the boom, the artificial booms that make the recessions necessary. But when you postpone or delay that recession, you simply allow the problems to get much worse. And that is what has happened now, which leads me to the investment angle here, because this bust is going to be bigger than the bust we had in 2008, and it's going to be bigger than the bust we had in 2001, right? And the most critical difference is going to be the aftermath, because while this is going to be a bigger bust because it's going to be proportioned to the boom, and we've never had a boom like this. I mean, the housing bubble was created by rates at 1%. That's as low as they got. And the Fed kept them at 1% for maybe a year and a half. And then it took them about another year and a half to get back up to 5.5, whatever it got to. And then, the bubble popped. Well, we left rates at 0 for 7 years. And then we never got them back to normal. The highest we got was 2.5, and now we're already back to 1.5. So if you can think about how bad the financial crisis was, and think about, okay, all the mistakes that led to that crisis were made because rates were at 1%. Imagine how many more mistakes were made because they were at 0. Right? Imagine how much more screwed up the economy is today than it was in 2008. Right? So we're on the precipice of a much greater collapse. And just like the 2008 collapse was blamed on Bush, this next collapse will be blamed on Trump. And it doesn't really matter if Trump takes the blame in 2020 or 2024. He's going to get blamed because there's no way that we're going to make it to 2024 without this bubble imploding. We may not make it to the 2020 election, but it's possible that the Fed will be able to maintain the illusion long enough to get to the 2020 election. That's possible. But I think it's very improbable that we'd make it to 2024. Now, when the financial crisis happened, remember, it didn't even happen really in a way that it made the public aware of it until the summer of 2008. So Bush almost got out of Dodge. I mean, he did from the point of view is he finished his second term, but he made it impossible for John McCain to have a first term. Because that bubble popped in the summer of 2008, anybody the Democrats would have nominated would have beat McCain because the public was blaming the crisis on the Republicans. Now, it wasn't the Republicans' fault per se. I mean, yes, Bush didn't do anything good. He simply allowed the bubble to continue. But it started with Clinton. He inherited the NASDAQ bubble from Clinton. And it popped early in his first term. And then the Fed inflated the housing bubble to paper it over. But Bush was associated with less government, tax cuts, deregulation, and that enabled the Democrats to blame the financial crisis on deregulation, on tax cuts, on capitalism, on not enough government. And then Barack Obama promised to change all that. And of course, he also promised to reduce the deficits because he was able to talk about the big deficits that Bush ran and say, hey, we need to have a responsible government. We've run these big deficits, and we've done all this deregulation. Of course, the financial crisis was a product of government. The Federal Reserve created it, and Congress with Fannie and Freddie and other government-insured mortgages and bank accounts that created the moral hazard. But the real fuel for the housing bubble was the cheap money supplied by the Fed. But the public didn't blame the Fed. They blamed Bush, and they elected Obama. And the other mistake that the Republicans made was cheerleading the Bush economy. And I pointed this out numerous times. Before Larry Kudlow was economic advisor to Trump, he was hosting a TV show on CNBC. I used to be a regular on that show in 2006 and 2007. I was on several times a month, probably on Kudlow Report. And I was one of the few people on that program from the Republican perspective that said we had a lousy economy, that we had a bubble, that it was going to pop, that we were headed for a financial crisis, that we were headed for a great recession. I was warning about that. And I said to Kudlow, both privately and on his show and other guests, that by cheerleading this economy, by pretending the economy is great, and Kudlow was saying it's the greatest story never told, it's the Goldilocks economy. Art Laffer and I had that debate. He still hasn't paid me his penny, where he was talking about we have this great economy because we have these tax cuts, and I pointed out to Art Laffer, it's not a great economy, it's a bubble. Right? It's a stock market bubble. It's a housing bubble. The stock market's going to come down, and real estate market's going to come down, and all that phony wealth is going to disappear. Right? He was, it's not phony. Of course it's phony. It's just on paper. Right? But what I pointed out to these Republicans, you are falling into this trap because you are claiming credit for this economy, which means you get the blame. You are held responsible when it's busts, when it turns out that it wasn't as good as you thought. And this is going to happen in spades now to the Republican Party with Donald Trump. Because Trump and all the Republicans have accepted complete responsibility or taken complete credit for this economy. They own it, which means they also own any problems that happen in the future. They own the next recession. They own the next financial crisis, and it is going to be a doozy. And so what does that mean? That means the president who follows Trump, whether it's in 2021 or 2025, is going to be way worse than Obama. Because it could be Bernie Sanders if it's 2021, or AOC if it's 2025. Right? She is the heir apparent to Bernie Sanders, and she's the right sex and the right color, right? And the right age. Right? She'll be young, female, minority, right? All she has to do is come out as gay. She'll have the trifecta or quit, whatever it is. But that is where we're headed, right? The public is going to embrace socialism because we are going to completely discredit capitalism by basically practicing socialism and labeling it capitalism. I mean, that was one of the things that frustrated me the most about Trump's State of the Union. Is he was saying, look how bad socialism is in Venezuela, and then advocating it here. At the same time claiming that he doesn't want socialism. He said he's going to defend Medicare and Obamacare, but he won't let socialism ruin our health care? What does he think those programs are? In fact, when he talks about the fact that we want to make sure that no insurance company can discriminate against somebody with pre-existing conditions, he's defending Obamacare because that is the essence of Obamacare, and he is completely against capitalism. Because in capitalism, It's important. The most important part about selling insurance is discriminating. You have to do that. If you're selling fire insurance, you can't let somebody buy a policy if their house is already on fire. What kind of insurance company would that be? You have to insure houses that you don't think are going to burn down. That's why you insure them. You can't insure somebody after they're sick. Then it's not insurance. It's only insurance if you buy it when you're healthy in case you get sick. If you wait till you get sick, you're not buying insurance. You want somebody else to pay your medical bills. And that's what Trump is saying. We want the government, we want the taxpayer to pick up everybody's medical bills. We don't want people buying insurance, right? We want people waiting till they get sick and then asking for somebody else to take care of them, right? But Trump is advocating this big government. That's why I'm joking. We have two parties now in America. One wants big government, right? Protectionism, cheap money, and the other wants socialism, right? That's what we're stuck with. But Trump's going to get the blame, and so we're going to have a socialist president. And what does that mean? Well, the deficits right now are running at 1.2 plus trillion per year, right? The government is borrowing over $100 billion a month now under Republicans when we're not even officially in a recession. Well, when Sanders comes in or whoever comes in and we're in a recession, the deficits are going to be $3 trillion, $4 trillion a year. Right? The government is going to be paying for everybody's college, paying for everybody's health care, creating jobs with what money? Oh, yeah, they're going to raise taxes on the rich. How many rich will be left after they finish raising taxes on them? That's the problem. You want to confiscate the wealth evaporates before you have a chance to confiscate it. That's what the Democrats are going to find out. So the deficits are going to go off the charts. And the reason that the dollar didn't completely collapse when the Fed did QE before, the reason that gold stopped going up when it hit 1900 was because everybody believed that the Fed's policies not only succeeded, but that they were temporary and that the Fed could reverse course and reduce and shrink the deficit or shrink the balance sheet and normalize interest rates. Well, nobody is going to be dumb enough to believe that the next time. It's going to be 0% forever. The balance sheet is going to go in perpetuity because the way the socialists are going to pay for all the free stuff is through the Fed. Modern monetary theory. Of course, there's nothing monetary about it or modern, and it's not even a theory because we already know it doesn't work because it's been tried before in Zimbabwe and all sorts of Weimar Republic, Germany, and places in South America. We know that that policy doesn't work, but that's what's coming. And so they're going to destroy the value of the dollar, and you've got to get your portfolios to reflect that now. You've got to recognize that the threat is not just that the stock market goes down or that the bond market goes down, because they will. Maybe you lose half your money if the stock market gets cut in half. But the important thing is the half that you haven't lost, that can lose 80% of its value because of inflation, because of the destruction of the value of the dollar. Consumer prices are going to rise dramatically. And, the Fed, of course, has already prepared us for this. They want more inflation. They're telling you they're going to create more inflation. They're just not telling you how much they're going to create. They're going to succeed beyond anybody's wildest dreams of getting that inflation rate higher than 2%, right? Because it's going to be much higher than 2%. And the first digit may even be higher than 2%, right? So we're going to have, runaway inflation, maybe hyperinflation. Certainly if I'm right on a Sanders or AOC type coming to power in 2021 or 2025. So the portfolios that you need to have to reflect this view. And a lot of people don't realize the last decade was a great decade to have been invested in the U.S. stock market. But the decade before that was horrible. The first decade of this century, from 2000 to 2010, was a disaster. The U.S. stock market went down during that decade. But you know what did really well? Gold, silver, gold stocks. They were up like 10x. Emerging markets killed it. 400, 500% gains. The dollar was cut in half during that decade. Euro doubled. Aussie dollar, New Zealand dollar. So people who were invested internationally made a lot of money in the first decade. Second decade, you made a lot of money if you were invested in the U.S. market. Kind of ironically, the financial crisis actually provided the springboard for the U.S. markets to do very well, even though it shouldn't have. It should have been a wake-up call to the problems. Instead, it caused another bubble in U.S. stocks and the dollar. But this next decade that we're in now, I think, is going to look a lot more like the first decade than the second. And in fact, the bubble that we have in the U.S. stock market today is much bigger than the one that we had in 2000. So you have a very similar set of circumstances. Everybody is bullish on the U.S. stock market, and they're bearish on gold, even though gold was at the bottom of a 20-year bear market in 2000. And then it went from under 300 to 1900 in a decade. Right, but you have the same kind of level of bearishness now, even though gold is 1560, 1570. People aren't buying it. That's what they should be doing. So the portfolios that you want to have now, if you look back at the portfolios that did well during the first decade of this century, that's how you want your portfolio to look. Except this time, I think they're going to do even better than they did then because it's a bigger bubble. The U.S. economy is far more screwed up today than it was 20 years ago. 20 years ago, the national debt was under $8 trillion. Now it's $24 trillion. The Fed's balance sheet was, a few $100 billion. Now it's over $4 trillion. Right? So we're much further along. The economy has gotten much more screwed up. So the dollar is much more overvalued today than it was 20 years ago. And I think despite the fact that the price of gold is up fivefold, I think it's actually cheaper today than it was back then if you look at all the money that's been created. Right? That's what gold really does. It's a measure of the value of fiat currencies. And the supply of fiat currencies has exploded, not just in the United States, but all around the world. But it's not just today's supply, but the future supply. How much more government debt is going to have to be monetized? Because again, the other reason they're going to monetize all this debt is because the alternative is default. If they let interest rates go up, we can't pay. So the only way that they can keep the government from defaulting is to monetize the debt and keep interest rates artificially low. So that guarantees an explosion in the money supply, which means the price of gold and the price of gold stocks are cheap. So what are we doing at Euro Pacific Capital today, right? And my asset management company, we are managing portfolios the same way that we did in 2000. And a lot of people were very excited in the 1990s because they owned all these tech stocks and dot-com stocks. All that profit was lost. And had it not been for the Fed, it never would have come back. I mean, had the Fed not lowered interest rates down to 1%, the market would not have recovered the way it did. But even with the recovery, all you did is maybe get back to even during those 10 years. Of course, a lot of people bailed out and didn't get back to even because they needed the money or because they just didn't have the stomach for it anymore. But my portfolios did very poorly in the 1990s because I was buying what nobody else wanted. I was buying the old economy stocks that nobody wanted when they were buying the dot-coms. Those were the stocks that went up 5, 10, 20x during the next decade. So I positioned myself and my clients to make money from 2000 to 2010 with the stocks that I was buying in the 1990s. I think the same thing has happened now. The stocks that I have been buying during the last decade when everybody else was bidding up U.S. stocks during a bubble, I think all those stocks that I've been buying that have underperformed the U.S. market are the ones that are going to explode up in this decade. Now, the gold stocks have already started. Gold stocks have doubled in the last 4 years. They beat the U.S. stock market last year. They beat it the year before. But we're just getting started. But most foreign stocks have still not come close to the U.S. stock market because the dollar has been strengthening. Well, once the dollar starts to fall, the way it fell from 2000 to 2010, when we get back into a bear market for the dollar, that's when all those non-dollar stocks are going to explode. So the time for people in this audience to buy these stocks is now. And in fact, all of our strategies bottomed out in December 2015, which coincidentally is when the Fed finally raised interest rates for the first time. That's when gold bottomed. That's when foreign stocks bottomed. The dollar topped out a little bit later, but the dollar is now rounding out a top. It hasn't really fallen, but it hasn't continued to rise. So we have portfolios that combine physical gold, gold mining stocks, right? I've got a gold fund, the Euro-Pacific Gold Fund, which you can buy either through our broker-dealer or you can buy it, Schwab, Fidelity. Morningstar gives me 5 stars for that fund. We have, I think, one of the only gold funds that's actually positive this year. Most are negative, even though the price of gold is up. But we've got a fantastic portfolio. Adrian Day is also here at the Money Show. He manages it. So I can't take credit for the success because I don't pick the stocks myself, although I can take credit for hiring Adrian to do it for me because it's a very specific industry. He's been doing this for 30 to 40 years. You don't want to just buy the GDX, the GDXJ, right? That's just, you're buying everything. You're buying some good stocks, but you're also buying some lousy stocks. Why not have somebody pick a portfolio that actually knows what he's doing, that understands the industry, because that's all they've done for 30 or 40 years. So, and I think this portfolio that he's put together, and a lot of junior mining stocks in particular, these are some of the stocks that can be 50, 100 baggers that are in our portfolio now. So you want to get into that. We also have separately managed accounts that Adrian manages for us, all in gold stocks. Now, if you want to be more conservative, obviously gold stocks, there's a high degree of risk. If I'm totally wrong, you could get killed in gold stocks, right? But if you just want a portfolio that I don't have to be right to make money, we do a lot of conservative dividend-paying foreign stocks that I think are going to do well even if I'm wrong. They'll do much better if I'm right. But I think if you're buying good quality companies in Singapore, in Hong Kong, in Switzerland, in Norway, in New Zealand, right? If you're buying good companies in countries that, have much better, macroeconomic characteristics, they have fewer regulations, lower taxes, trade surpluses instead of trade deficits. They rank higher in economic freedom than the United States, not lower, right? They have sounder monetary policies. I mean, nobody has sound monetary policy. It's all a relative scale. But if you invest in the countries that on a relative basis are freer, have fewer regulations, better fiscal characteristics, right? You're going to do better in those countries, especially if you focus on stocks that represent good investment value, right? We're buying stocks with good dividend yields at lower PEs. We're not chasing momentum. We're collecting dividends in Swiss francs, right? In New Zealand dollars or in Singapore dollars or Norwegian krona. So these currencies are going to rise in the event the dollar falls. They won't rise as much as gold, but they'll rise, right? But if I'm wrong, there's not as much downside. So we have portfolios that we're putting together of foreign stocks that pay good dividends. We manage them. I have mutual funds that do that. I have a value fund. I have a dividend payers fund. So you can get that through my mutual funds, or you can have a separately managed account. We also offer at Euro Pacific Capital wrap accounts where I will invest you in my 5 different mutual funds. And there we build a portfolio of my mutual funds that we can fine-tune the allocations. So if we want to move some money out of emerging markets into bonds, we could do that. We want to move some money from bonds to gold stocks, we can do that. And so we can set up those accounts. Kyle is here. He works in the Boca Raton office. And so he can follow up with you when you fill out these cards. For physical gold, we do sell physical gold through my broker-dealer, through the Perth Mint. We store the gold. But if you want coins and bars sent to you, which I recommend that everybody have some quantity of physical gold, Schiff Gold is my gold company. And you just go to the website at schiffgold.com. And we have very competitive prices. We don't deal in any numismatics, which is what you want to make sure. A lot of gold salesmen, they try to upsell people into numismatics because there's a huge markup there. They mark these things up 30, 40, 50%, sometimes more. We mark up gold and silver 1% to 2%. Right? So the markups in bullion are very low. That's what you want. You don't want to become a coin collector unless that's what you want to do. But if you just want to hedge against inflation and you want to have real money instead of fiat, then you don't want to collect rare coins. You want bullion, right? You want coins that are very close to the spot price of gold. Another good way to do it, too, is just go online and set up an account at Gold Money, goldmoney.com. You could buy gold. You don't get delivery of it, but they'll store it for you. You could take delivery in the future, but if you want delivery, just buy, get it from Schiff Gold. But if you want to have some gold stored in a Brinks vault in Switzerland or, Canada or Singapore or someplace like that, just go online to goldmoney.com. They have very, very low fees. It's 0.5% to buy, 0.5% to sell, and their storage costs are very, very low, much lower than what you store if you buy an ETF. Like if you go and you buy GLD, there's a storage fee for GLD that's much higher than what you're paying to store your own gold at Gold Money. And the difference is when you have an account at Gold Money, that's your gold. When you own GLD, you own a pool. And you're hoping that the auditors are accurate and that the gold that they claim is there actually exists. Right? With Gold Money, you know it exists. Or if you buy it and I ship it to you and you put it in your closet somewhere, you know you have it. Right? You don't really know what you have in an ETF. You just have to take the word of the auditor. Now, they're probably right. The gold's probably there. But if you have it yourself, you know for a fact that it's there. So everybody should have some physical gold. But I do think that people should err more now in having more of their gold exposure into the equity markets. I think that because nobody really has any idea how high the price of gold is going to go, most people expect the price of gold to fall. The gold stocks are incredible bargains as far as I'm concerned. So I think that you want to be in gold stocks and at least let them triple, quadruple before you start paring them back. I think if the price of gold goes to 2,000, which is where the high was in 2011, about 1,900, and if Sanders wins the next president, it'll be at 2,000 on election night. I mean, if it's not already there because the polls show him winning. But 2,000 from where we are now is about a 25% rise in the price of gold. That's it. But I think gold stocks will double or triple if the price of gold goes to 2,000 from here because nobody expects it. People just assume the price is going to go down. So once the price really breaks out, I think you're going to see a lot of buying, particularly among institutions and hedge funds. Nobody is worried. Everybody is optimistic, just like they were at the peak of the dot-com bubble or the peak of the housing bubble, right? People are always excited at market tops. And when they're excited, when they expect the market to go up forever, they're not interested in gold. They're not interested in gold stocks, even though gold is outperforming every market other than the U.S. market. Gold is at a record high in every currency other than the U.S. dollar. And in fact, last year, the Perth Mint had its best year ever in physical gold sales, while the U.S. Mint had its worst year ever. So the world is buying gold and Americans are not. Why? Because only Americans are foolish enough to think everything is great, right? Because our stock market is beating gold, whereas no other stock markets are, because we're in a big bubble. And a lot of the gold buyers are Trump voters, Trump supporters. I know that. They're my customers. Republicans buy gold, not Democrats. And Republicans were worried when Obama was president. They're not worried now. Even though gold is already on par to do better under Trump than it did under Obama. In fact, it already is. If you measure the increase in the price of gold from the day Obama was elected to the day he left office, that percentage gain is less than the gain so far since Trump's been president. So gold's doing very well under a Republican president, even though Republicans aren't buying it. They're buying into the stock market just like they did at the peak of 2000 and 2008. So the smart money is selling U.S. stocks now, selling U.S. dollars before the bottom drops out, and loading up on foreign currencies, foreign stocks, gold, and gold stocks. Thanks, everybody, for coming. It's off to Disney World.